Welcome to the 3-Edge Week in Review for the week of October 9th. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge. Joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. Today, I'm recording our weekly video from the historic Mountain View Grand Hotel in the White Mountains of New Hampshire, where this morning it was a brisk 39 degrees. Later this morning, I'll be making a presentation to a group of independent advisors who utilize the 3-Edge strategies on behalf of their clients. Always enjoy the opportunities to understand what advisors and their clients are thinking about the markets and what concerns they may have. This week, Steve and I will be discussing the recent invasion of Israel by Hamas and how this situation could increase already elevated levels of geopolitical tension throughout the world. And we'll consider what impact this conflict could have on the global capital markets. News of the invasion of Israel by Hamas was one of those kind of stunning events that seemed to render all other news irrelevant for the time being. And what is taking place in Israel and Gaza represents an extreme human tragedy. So it can feel uncomfortable to speak about the events of the past week in terms of the capital markets. However, the nature of our job here at 3-Edge is to preserve our clients' capital, so we must consider the market implications of what has transpired and what may transpire in the days, weeks, and months ahead. At 3-Edge, we have been discussing geopolitical tensions in the world and how they're on the rise. And unfortunately, the Middle East has historically been a hotspot of conflict, seemingly forever. The greatest danger from this situation, for not just the markets, but the entire world, is that it could escalate into a wider conflict. Almost immediately after the fighting began, the foreign policy community began to consider the level of potential cooperation and support that Hamas may have received from Iran. And other players in the Middle East could be drawn into this conflict, including Hezbollah, a militant group based in Lebanon on Israel's northern border that functions as a proxy for its largest benefactor, Iran. And Hezbollah has far greater military capabilities than Hamas. It seems reasonable to also assume that one of the goals of Hamas in invading Israel was to disrupt the negotiations between Saudi Arabia and Israel, which appeared to be getting close to some formal diplomatic agreement. In terms of the reactions in the markets, currently, investors seem to be behaving as though this conflict between Israel and Hamas can be somewhat contained and will not spread to the rest of the Arab world. Oil prices already considered whenever there's a conflict in the Middle East. And at least for now, oil prices haven't spiked dramatically higher. Brent crude is trading around $86, $87 a barrel. In addition, bond yields didn't see a dramatic decline in what you might consider would have happened, which would have been a flight to safety of the government bond market. Yields remain elevated. So for now, markets assume that the conflict between Israel and Hamas will be contained. However, there are many potential scenarios wherein the conflict could spread throughout the Arab world and beyond, which could dramatically impact the economy and the global capital markets. So now let me bring Steve in here to discuss the situation. And Steve, why don't we start with your insights into the conflict between Israel and Hamas, including just how this conflict could impact the global capital markets in the days ahead.
Well, thank you, Fritz, and thank you for expressing how it can seem a bit awkward to discuss the markets during a time of such extreme human tragedy. But I want to begin by drawing an analogy to 9/11, September 11th, 2001, when we had the terrorist attack against the U.S. And there's a theory that behind that attack was the idea that Al-Qaeda anticipated and tried to provoke a major response from the U.S. to get the U.S. bogged down in a wider war and bring down our economy. And so there's another analogy or theory that perhaps that might be potential what's in play here, where Hamas made this horrific attack, anticipating a very strong response and drawing a wider conflict that might, in their view, bring Israel's economy down and cause further problems. So that's something that we've got to be very concerned about. We've got to be very careful to watch any signs of a wider conflict that goes beyond Israel's and Gaza Strip borders. For example, if Iran were to get directly involved, more so than just the indirect involvement that may be there, and they were to close the Straits of Hormuz, we could get an oil shock, and that would have obvious implications to the global markets.
As we know, and as we have been telling our clients, even before this outbreak of violence in the Middle East, the inflationary environment that we're experiencing here in the U.S. seemed to have parallels with the inflation in the U.S. in the 1970s. So it was uncanny how the conflict between Israel and Hamas once again brings the Middle East into the inflationary picture, just as it did back in the 1970s. So perhaps you could delve into the comparison between today and the 70s in terms of inflation and describe how events in the Middle East were at play in the story of the 1970s inflation and how that could happen once again in the current inflationary environment.
Well, Fritz, you and I have been discussing this long before the recent outbreak. And the parallels with inflation, so far are following the same cycle. And we can look at this accompanying chart. And like in the 70s, not that long ago, we had a big rise in inflation here in current time, all the way up to a little over 9% in the U.S. CPI rate. Very similar to what happened in the 70s, where out of the blue, inflation picked up beyond anyone's expectation. And there it even went up to 12%, as you can see in the chart. And then there was a turnaround, and inflation began to come down then, just like it did here. We get down to the 3% range recently. And inflation in the 1970s fell almost half of what it was in a pretty short time. And again, in the 1970s and now, we're seeing a lot of market analysts saying that, well, inflation is whipped. We don't have to worry about it anymore. It's coming down. Market variables project that inflation is going to come down close to 2% and stay there for an indefinite period. So there's a lot of complacency about inflation, but the same thing happened in the 1970s. And instead of inflation continuing to come down, it stabilized at a rate higher than it was previous to the cycle starting, and then began to go up again. And the complacency happened because, or the rebound happened because back then the central bank thought now they could back off the monetary tightening. There's no longer a worry about inflation. They don't want to overdo the tightening, and they backed off too early. And there are signs now that people are advocating that the Fed backs off, no more rate hikes, in anticipating another rate cut. So that's all been quite similar in parallel. But now, as you mentioned, Fritz, we throw in, another uncanny parallel, which is the Middle East, geopolitical tension. And back then we had oil price shocks. And even though the market's not anticipating that to happen this time around, I think it's premature to say that we won't get a wider conflict. And there's some non-zero probability that we could get another oil price spike. So we have to take that into consideration.
As always, my final question is, based on what we have discussed here today about the tragic events occurring in the Middle East and the potential for this conflict to impact the markets, how might investors consider adjusting their own investment portfolios?
Well, again, back to the current market environment, we believe, in our opinion, the markets are perhaps overly complacent. There hasn't been a lot of market movement since this conflict started last Saturday. And we do think there's at least some probability of a wider conflict spreading and a lot more problems that will affect the market. So we think it's still reasonable to stay relatively cautious and defensive. Now, if we do get that wider conflict, if we get an oil price shock, this would drag our economy into a stagflation. In a stagflation, we would favor short-term treasuries. We would favor TIPS or Treasury Inflation Protected Securities. We would be glad we own some gold. And those would be all important hedges against further deterioration in the economy and higher inflation. At the same time, because the U.S. markets are overvalued despite all of this trouble, we would still be at our minimum range of U.S. equity investment. We'd still be cautious on U.S. equities. But we have been overweight some international equities, such as Japan, where we see quite high relative undervaluation, some signs of corporate profit growth there, and where they continue to be very stimulative with their monetary policy. We've been looking at potential rebound in emerging markets and very modestly looking at safer ways to maybe tap into some rebound, but very cautiously. So overall, I think it's important for any equity investing to invest where you have more of a margin of safety through undervaluation. And meanwhile, we will be watching the situation extremely closely to see if we need to make any other adjustments or get even more conservative and defensive in our portfolios.
Okay, great. Steve, thanks for your insights and for helping us to better understand how the current situation in the Middle East could impact the markets in the days and the weeks and the months ahead. And again, here at 3Edge, we realize that what is happening in Israel and Gaza is a human tragedy on a massive scale. But we also know that our clients are counting on us as stewards of their hard-earned wealth. And so we believe it's important and helpful for our clients and listeners to better understand the potential market implications of these recent tragic events. So that will do it for Steve and me for this week. We'll be back next week with the next edition of the 3Edge Week in Review. And as a reminder, all our videos are available on our 3Edge YouTube channel. And if you think that someone you know might enjoy and benefit from our weekly videos, please feel free to share them by sending them the link to our YouTube videos on our 3Edge YouTube channel. So on behalf of Steve and everyone here at 3Edge, thanks for listening.